Hello viewers, welcome to my channel. I am Hashim Ali Khan. So now I am going to start the new topic, that is accounting for price level changes in the subject advanced corporate accounting. Already two topics I have completed fully, that is holding companies and accounts of electricity companies. This is the third topic in the subject advanced corporate accounting. The topic name is accounting for price level changes. So in this video I am going to explain you the detail, the theoretical part of what is accounting for price level changes and what are the methods available for accounting for price level changes. So these are the things I am going to discuss in this video. So watch the video till the end to get the complete command on this topic of accounting for price level changes or inflation accounting. Now apart from this, if you are new to my channel, I suggest you to visit the playlist of my channel. I have uploaded videos on so many subjects like financial accounting, cost accounting, corporate accounting, advanced corporate accounting, managerial accounting, business statistics, income tax, financial management, investment management. So many subjects videos I have uploaded. Select your subject, select the video, watch the video and enhance your knowledge. Get the confidence on your subject. So now I'm going to start the new topic, accounting for price level changes or inflation accounting. First of all, I'll explain you about the objective of accounting. The objective of accounting is to prepare the financial statements which should give the true and fair view of the operating results and the financial position of the enterprise, of the concern. So the basic objective of accounting is to prepare the financial statements, and the financial statements should portray a true and fair view of the operating results and financial position. So in order to make these financial statements, a number of concepts and conventions are followed, because the financial statements will give the information to so many users. The users of accounts are investors, creditors, government, then management, then general public. So there are many users of the accounts. So the accounts should show the true financial position of the business. So in order to make these financial statements, we follow a number of concepts and conventions. After following those concepts and conventions, we can be able to make the financial statements. One of the basic concept is money measurement concept. According to this concept, we will record only those transactions which are in terms of money, which are measured in terms of money. Only monetary transactions will be recorded in the financial statements. Non-monetary events or transactions will not find any place in accounting. Assuming that the value of rupee, the value of currency, money will remain same. The value of money will remain same. That is the assumption normally we'll make while preparing the financial statements. But unfortunately, throughout the world, even developed countries or developing countries, every country is facing the problem of inflation. Inflation means the continuous rise in the general price level. When the prices of goods and services are increasing, that situation is called inflation. Every country will have the inflation. And due to inflation, the purchasing power of money is coming down. The value of money is coming down. And we are recording all the transactions in terms of money, but money itself is unstable, not stable at all. The value of money is changing from time to time. That is a drawback, that is a fact. But this fact is not considered in financial statements. We are preparing the financial statements assuming that the value of money is remaining same. The purchasing power of money is remaining same. That is not true. So inflation accounting is a technique of restating the financial statement by incorporating the changes in price level. What is the effect of changes in price level that will be incorporated in making the financial statements, or we restate the financial statement by incorporating this price level changes. That is inflation accounting. Why we call it as inflation accounting? Assuming that there is inflation, but it is not necessary. There may be some deflation also. In that case, it is better not to call inflation accounting. It is better to call accounting for price level changes. That will include both inflation as well as deflation. That is a brief introduction about this inflation accounting. Now, history of inflation accounting. Actually, history goes very long back. First of all, the systematic approach of study of inflation accounting was given by Henry Sweeney in USA in 1936 through his book called Stabilized Accounting. From then onwards, many debates was conducted, many deliberations, many discussions were conducted by professional bodies throughout the world, particularly USA and UK. A number of debates were conducted, discussions were made, statements are prepared how to incorporate these price level changes in accounting. Then only the accounts will show the true and fair view of the state of affairs. So till now, many discussions still going on. There is no consensus among the treatment, among the method of incorporating the price level changes in accounting. Still the work is going on, research is going on. No consensus still has been made, but still some methods are there. Those methods we are going to understand. So this is the history of inflation accounting. Limitations of historical accounting. Very frequently in examination, a theory will be asked regarding limitations of historical accounting. Historical accounting is conventional accounting. In that, we will not consider the changes in the purchasing power of money. We assume that the value of money will remain same from time to time, and accordingly we prepare the financial statements. There are many advantages of historical accounting. It will be free from bias. It will be easily, verifiable. It easily can be prepared. So without considering the price level changes, easily we can make the financial statement without bias and without any, personal judgment. So easily we can make. But there are a number of limitations by which this historical accounting will suffer. So what are the limitations of historical cost accounting? That question will be frequently asked in examination. So objectives of accounting not fully met. First limitation of historical accounting is the objective is not met. What is the objective of accounting? The objective of accounting is to prepare the financial statement which should show the true and fair view of the operating results and the financial position of the business, of the concern. But when we follow historical accounting, we are ignoring that the value of money is changing from time to time. That is the fact. That fact we are ignoring. We are assuming that the purchasing power of money is remaining same from time to time, and accordingly we are making. So financial statements will not show the true and fair view of the state of affairs of the business. That is the first limitation of historical accounting. Secondly, overstatement of profit and understatement of assets. When we do not consider the time value of money, that means the changes in the price level, what will happen? The profits will be the overstatement of profit. The profits are overstated. Because, simple example I'll give you, there are many reasons why the profits will be overstated when we ignore the price level changes. Is, first of all, we provide the depreciation on historical fixed assets. The fixed asset was purchased some 10 years back. We are providing depreciation on that fixed asset which was purchased 10 years back. That means the depreciation amount will be less. When depreciation amount is less, that definitely the profitability will be overstated. The profits are overstated. That's the drawback, limitation. Similarly, the assets are understated in the balance sheet. When we are not showing the assets at its true current value, we are showing only the historical value. But the replacement cost will be different. If you purchase a new asset, if you replace the old asset by a new asset, the cost will be different. So that is the drawback. Next one, replacement of asset is not fully provisioned. See here, a provision should be made that at the expiry of the life of the old asset, a new asset should be purchased. But when we provide depreciation on old asset at the old value, then sufficient amount will not be there at the time of replacement. because at the time of replacement, the price of the machine has gone up. Earlier, we have purchased the machine for 1 lakh. Every year, we are writing down 10,000 rupees depreciation, 10 years life. Now the life is over. Now we are having 1 lakh rupees. But when we go to purchase a new machine, the new machine is costing 3 lakh rupees. So we can be able to replace because we have provisioned only 1 lakh. But the new machine is costing rupees 3 lakh. It will be difficult. This is the limitation of historical accounting. Next one is mixing up of holding and operational gain. Actually, profit and loss account should show what are the factors which affect the profit. The profit and loss account should disclose all the factors which affects the profit. But in case of historical accounting, we are not distinguishing between operating results and monetary results. Monetary results means loss or gain on holding monetary items. Loss or gain on holding monetary items, that will not be considered in historical accounting. In historical accounting, only operating profit we are calculating, ignoring the fact that in calculating operating profit, automatically monetary gain also included or monetary loss is also included. Next one is misleading comparison. We cannot make the comparison. Simple example I'll give you. Suppose ABC company, XYZ company, two different competing companies, business are there. ABC company purchased a machine for rupees 10 lakh in the year 2010. Exactly same machine is purchased by XYZ company in the year 2015 for rupees 12 lakh. That means machines are same, but ABC company has purchased in 2010, XYZ company has purchased in 2015. The prices are different. Machine is same, but the price are different. So when they calculate the ratios on these assets, the ratio will be misleading. We cannot compare the performance of ABC company with XYZ company because both have purchased the assets at different time, at different value. So comparison not possible. Similarly, a single company cannot compare the performance of 1 year with another year. Next one is gain or loss on net monetary assets not disclosed. See here, there is gain or loss on holding monetary assets and monetary liabilities. Monetary assets are those, monetary items are those items whose value is fixed through contract. That means the value will not change. Simple example, a business has taken a loan of rupees 1 lakh from the bank, which is repayable after 5 years. After 5 years, it will be repayable. So that 5 lakh rupees amount will remain same. Whatever be the level changes in the price level, the business has to repay back to the bank same amount what they have borrowed. This is a monetary item. Similarly, when we purchase the goods from a creditor, from a supplier, we promised him to pay after 6 months. So after 6 months, we will pay the agreed amount. This is called a monetary item. So by holding during the inflation period, if we hold monetary assets, we will lose. By holding monetary liability, we will gain. So this gain or loss on holding monetary assets and monetary liability are not considered in historical accounting. Next one is aggregation of heterogeneous figures. Heterogeneous means not same, not identical. We are clubbing and aggregating the heterogeneous item. Simple example I'll give you. One machine was purchased in 2010. Another machine was purchased in 2015. Both the machines we add up. In the balance sheet, we add up both the machines. But it is illogical because one machine is purchased in 2010, another machine is purchased in 2015. When the purchasing power of money is different, changed, how we can add up? But unfortunately, in historical costing, we add up both the machines. That is the drawback. Next one, faulty decision making. Without considering the price level changes, the management may take the wrong decisions regarding capital structure, working capital, or a number of business decisions. That price level changes must be considered. Next one is misleading ROI, return on investment. This is return on investment or return on capital employed. This is very important ratio which is calculated. But without considering the price level changes, if we calculate ROI, return means profit. The profit may be overstated and the investment may be understated. So both the numerator and denominator of ROI will get affected if we do not consider the price level changes. That means misleading ROI will get. Next one, consequences of overstatement of profit. If profit is overstated because we have not considered the price level changes, then what will happen? The paper profit will be more. The book profit will be more. In that case, there is more possibility that taxes will be high. The profit and loss account is showing more profit. That means the tax liability will increase. Apart from that, more incentives will be asked by the workers, employees. More wages we have to pay. Similarly, the investors will demand more dividend because the profit and loss account is showing huge profit. So these are the consequences if overstatement of profit is there. Why overstatement of profit? Because we are not considering the price level changes. Different bases used. There are different bases used. Example, while calculating the fixed asset, we are calculating the fixed asset original cost, historical cost. Whereas while calculating the profit and operating result, we are comparing the current revenue. So different bases we are using for different types of assets. Next, violation of matching principle. Matching principle will get violated because on one hand, revenue we are calculating at the present value, whereas the cost is calculated at or actual cost or market price, whichever is higher. So in stock, while calculating the stock, we are following a different method. While calculating the revenue, we are following a different method. So matching principle is not followed in case of historical cost accounting. So these are some of the limitations due to which the historical cost accounting will suffer from many disadvantages. So this is the theory regarding limitation. Now, price level accounting or inflation accounting. What is the meaning? What is the meaning of price level accounting? Or simply it is called inflation accounting. It's a technique of restating. It's a technique of restating the financial statement by considering the price level changes. The price level accounting is a technique of restating the financial statements by considering the price level changes. That is called inflation accounting. So by making inflation accounting, we can be able to get the true operating results and the true financial position of the business. Next comes methods of accounting for price level changes. So far, two methods are commonly used for accounting for price level changes. The first method is current purchasing power method. It is known as CPP method. Current purchasing power method. And this method is based on changes in the general price level. The general price level will be disclosed by the index numbers, whether it is wholesale price index or consumer price index. We'll take the index number. Index number will show the general price level. So restating the financial statement by using general price level, is called CPP method. That means all the items of the financial statements will be restated by using index numbers. That is CPP method. Another method is current cost accounting method or CCA method. Current cost accounting method or CCA method based on changes in the price of specific assets. It is not necessary that all the assets will show the changes in the values. Some assets may show more change, some assets may show less change. So we should not treat that the value of all the items will get changed. Some items may change, some items may not change. In that case, specifically we will change only those assets whose value have changed. That case we will call CCA method, current cost accounting method. So these two methods are commonly used for incorporating or restating the financial statements by price level changes. So there are two methods of restating the financial statement in terms of current purchasing power. The two methods are CPP method and CCA method. So first we'll discuss about CPP method, current purchasing power method. It's a technique of restating the financial statement in terms of general price level. The general price level will be indicated by index numbers. So by using the index number, we restate all the financial statement items and make the income statement and balance sheet as per the CPP method. So here I have written current purchasing power method CPP to convert historical based financial statements to CPP adjusted financial statement. General price indices are used. General price index, the index number may be wholesale price index or consumer price index. So any index number is there that will make use to convert the financial statement from conventional historical method into this CPP method. All items of income statement and balance sheet are restated on the basis of prime price index at the end of the year. We are preparing the financial statements at the end of the year. So at the end of the year, we have to restate all the items at the current value at the end of the year. Right? Now, conversion factor. First of all, while applying CPP method, we have to find out conversion factor. What is the conversion factor formula? Price index at the date of conversion. Date of conversion means end of the year. We are closing the accounts on 31st March 2018, suppose. We are preparing the financial statement as on 31st March 2018. So this is the date of conversion. We take the index number on this date of conversion in numerator. In denominator, price index at the date the item arose. When the item arose, that index number at that item. For example, opening stock. Opening stock was 1 lakh at the beginning of the year. Opening stock. At that time, index number was 100. Index number was 100 at the beginning of the year. At the end of the year, the index number is 125. End of the year, at the time when we are converting, it is 125. So we take the conversion factor 125 by 100. So whatever historical value is there, that historical value will be multiplied by conversion factor. That is 125 by 100. So 1 lakh into 125 by 100, you will get 1 lakh 25,000. So historical cost, historical value of opening stock 1 lakh. Whereas CPP value of opening stock is 1 lakh 25,000. Because we have multiplied with conversion factor 125 by 100. The historical value is multiplied with correct conversion factor to get the CPP indexed value. Just now I have given the example. Now calculation of net monetary loss or gain. Net monetary loss or gain. See, a business organization will get the gain as well as loss on holding monetary items. Monetary items means monetary assets as well as monetary liabilities. The monetary assets are those items which are fixed and which will be conducted after a period of time. Example, we sold the goods. We sold the goods to a customer for rupees 1 lakh, repayable after 6 months. So we sold goods on credit to a customer for rupees 1 lakh, repayable after 6 months. That means after 6 months he is going to pay 1 lakh rupees only, irrespective whatever be the level in changes in the price level. So this is called a monetary item. Similarly, a bank loan is taken repayable after 5 years. That's also monetary item. Creditors, we have purchased the goods from the supplier. Amount is repayable after 6 months. That's also monetary item. So every business will have some monetary assets and monetary liabilities. So during inflation period, if there is inflation, a business organization will lose by holding monetary assets, and the business organization will gain by holding monetary liability, because monetary liability will be payable at the fixed amount. Whatever be the level of price level changes, we are paying a fixed amount. Similarly, assets, we are going to get a fixed amount after a period of time without ignoring whatever be the changes in the level price level changes. So these are called monetary items. So we have to adjust for monetary loss and monetary gain. So we will calculate what is the monetary gain on holding monetary liabilities and what is the loss on holding monetary assets. Suppose monetary gain is 10,000 and monetary loss is 7,000. So 10,000 gain and 7,000 rupees loss. So we deduct 3,000 rupees is the net monetary gain on holding monetary items, and this 3,000 will be added to the net profit as per historical accounting. As per historical accounting, whatever net profit we get, to that net profit we add up this net monetary gain or loss on holding monetary items. Next, third one, valuation of inventory and cost of goods sold. We know cost of goods sold formula is opening stock plus purchases minus closing stock. Now this COGS, cost of goods sold, we have to convert it into CPP method. So individually three items are there: opening stock, purchases and closing stock. These three items we have to restate according to CPP method. How to restate? Take the historical value, that will be multiplied by conversion factor. For example, opening stock. The opening stock is 1 lakh rupees and the conversion factor is 125 by 100. 125 by 100 is the conversion factor. So we multiply 1 lakh into 125 by 100, 1,25,000. So 1,25,000 is the CPP value of opening stock. Similarly, purchases. The purchases during the year. The purchases during the year are 10 lakh rupees. Now this will be multiplied by conversion factor. But in this conversion factor, we will take the index, average index of the year, because these purchases are not made at the beginning of the year or end of the year. It is made during the year. During the year. So that's why we'll take the average index. We'll take the average index. So conversion factor, what will take? The index number at the date of conversion, end of the year, divided by average index. Suppose the average index is 120. Average index is 120. End of the year index is 125. So we'll multiply 10 lakh into 125 by 120. Will that the CPP value of purchases. Then closing stock. We have to find out the closing stock CPP value. Historical closing stock is given. Now we have to restate that into CPP method. How? Now while calculating closing stock CPP method, we have to see whether the business is following FIFO method or LIFO method. Because it depends. This stock is remaining from which lot? Is the closing stock remaining from opening stock lot? Or is this closing stock remaining from purchases lot? If the business follows first in first out method, FIFO method, then naturally this closing stock is remaining from purchases. Because when we follow FIFO method, the old stock, the opening stock was already issued. So whatever closing stock is left, that is remaining from the purchases. But if the business follows LIFO method, last in first out method, in that case the closing stock is remaining partly from opening stock also. Partly from opening stock also. So we have to restate this closing stock in CPP method by seeing whether it is FIFO method or LIFO method. This concept will be more clear by doing the problem. We have a number of problems in calculating COGS value according to CPP method. Next comes fixed assets and depreciation. The fixed assets and depreciation should also be restated according to CPP method. The fixed asset, again we multiply by conversion factor. Conversion factor, the closing index. At the end of the year index will take numerator and the index number of the date of purchase. When the fixed asset was purchased, the date, that index number will take it in denominator. And whatever conversion factor we take for fixed asset, the same conversion factor we take for depreciation also. If information is not given regarding when the fixed asset was purchased, so we take the index number at the beginning of the year. Index number at the beginning of the year, that will be taken in denominator. That's all. So these are the adjustments we have to make in CPP method for restating the financial statements from historical method to CPP method. The second method of accounting for price level changes is the current cost accounting, CCA. Already we have discussed about CPP, current purchasing power method. That is the first method of accounting for price level changes, inflation accounting. The second method, current cost accounting method, CCA, and it is based on the concept of capital, which is represented by net operating assets. That means this CCA method is based on the concept of capital, which should represent the net operating assets. What are net operating assets? Here I have shown fixed assets plus stock plus monetary working capital. Working capital means the difference between current assets and current liabilities. Current assets minus current liability, you will get working capital. So net operating assets means fixed assets plus stock plus net monetary working capital. If these three combine together, it constitutes net operating assets. And this net operating assets should represent the capital. That means capital and net operating assets should be equal. This is according to CCA. Measurement of profit under CCA. Now how to calculate the profit according to CCA method? So the CCA method is designed to measure the profit in such a manner as to ensure the operating capability of the enterprise. That means we have to find out the profit in such a manner which shows the operating capability of the enterprise. The current cost profit is achieved in two stages. How to find out the current cost profit? In two steps. The first step, current cost operation of profit, is determined after allowing for the impact of price changes. First, we calculate the profit as per historical accounts. To this, we make some adjustment regarding price level changes. Some special adjustments we have to make in the first stage. Second stage, where the firm is financed from borrowings as well. If there is a long-term debt, if there is a borrowing in the business, then one more adjustment is required called gearing adjustment. But gearing adjustment is required only when the firm is having long-term debt, long-term borrowing. If there are no long-term borrowing, only in one step we can be able to find out the profit as per current cost accounting. Now, what is the format of finding out the current cost profit? Here in a tabular form I have shown you. So current cost accounting income statement is prepared in the following format. First of all, we'll take historical cost of trading profit. That means the profit as per the conventional accounting or historical accounting. Before interest, before charging any interest, what is the profit? To this we will deduct from the profit we deduct adjustment, current cost adjustment. Remember, three current cost adjustment are there: depreciation adjustment, cost of sales adjustment, COSA, and lastly net monetary working capital adjustment, MWCA. So these three are the adjustments which should be deducted. These adjustments are called current cost adjustment, and these three adjustments should be deducted from the net profit as per historical accounts. What we get is current cost operating profit. After deducting three adjustments, we get current cost operating profit. To this, we add gearing adjustment if there is any. If in the problem gearing adjustment, when the gearing adjustment will be there? When there is borrowing, when there is long-term debt. The gearing adjustment we have to add up. But if in the problem interest charges are given, so from gearing adjustment, deduct the interest charges and take the amount in the outer column. Outer column you have to add. For example, 10,000 rupees gearing adjustment and 2,000 rupees interest. So 10,000 minus 2,000, you will get 8,000. That 8,000 will take it in the outer column and add up. So this current cost operating profit, add this gearing adjustment, will get current cost operating profit before tax. From this, deduct income tax. We'll get profit to shareholders after tax. From this, deduct proposed dividend if it is there. Then we get retained earning. To this, add opening balance of retained profit. What we get ultimately? Closing balance of retained profit. So in this way, we are going to find out the income as per CCA method, current cost accounting method. Totally 4 adjustments are there. The 4 adjustments are depreciation adjustment, cost of sales adjustment, COSA, monetary working capital adjustment, MWCA, and gearing adjustment. So these 4 adjustments are required for calculating the profit as per CCA. So one by one adjustment we'll discuss now. Depreciation adjustment. Additional depreciation needs to be provided over and above the depreciation charged under historical costing. See here, under historical costing, depreciation will be calculated on historical cost. On historical cost. Now at the time of restating the profit as per CCA method, then depreciation should be provided on the present value of the asset, not on the historical cost. See here, what will happen? If depreciation is provided on historical cost basis, then this amount of depreciation will not be available, will not be sufficient for replacing the asset. One of the purpose of depreciation is that we will provide depreciation and we will keep aside that amount of depreciation so that this depreciation amount will get accumulated, and at the end of the life of the old asset, a new asset will be replaced. So if we provide depreciation according to historical basis, then the business will not have sufficient funds to replace a new asset in place of old asset at the expiry of the life of the old asset. For that purpose, we have to charge additional depreciation during the current year. For example, according to historical method, depreciation charged was suppose 10,000 rupees. 10,000 rupees is the depreciation charged according to historical method. Now, according to current cost, the depreciation comes to 16,000. According to current cost method, the depreciation on the current value of the asset comes to 16,000. So already depreciation provided according to historical method 10,000, but according to current cost method depreciation comes to 16,000. So additionally 6,000 rupees depreciation should be provided. Additionally 6,000 depreciation should be provided. This is called depreciation adjustment account. A number of problems are there regarding this depreciation adjustment. We'll discuss more. Right now you remember that 4 adjustments we have to make in order to find out the income as per CCA. Now, second type of adjustment are COSA, cost of sales adjustment. The cost of sales consists of opening stock plus purchases minus closing stock. If we have to make the assumption that sales and purchases are evenly done throughout the year. That means there is not much impact on sales and purchases because both sales and purchases are done equally, evenly throughout the year. So the difference will arise only in case of stock, opening stock and closing stock. So this COSA, cost of sales adjustment, will be done only on opening stock and closing stock. Because opening stock was there at the beginning of the year and closing stock was there at the end of the year. So value of money will not be same. The value of money has changed from beginning of the year to end of the year. So we have to make the adjustment regarding the changes in the value of opening stock and closing stock. So COSA. COSA allows for the impact of price changes when determining the charge against revenue for stock consumed during the year. So the formula for COSA is C minus O. C stands for closing stock, value of closing stock as per historical method. O stands for value of opening stock as per historical method. Both historical. Closing stock historical value, opening stock historical value. C minus O minus IA. IA stands for average index. I stands for index. A stands for average. So index, average index throughout the year, during the year, that will be taken here. C divided by IC. C stands for closing stock. IC stands for index number of closing stock. Index number of closing stock. Minus O stands for opening stock. IO stands for index number of opening stock. So by using this formula, we can get COSA, cost of sales adjustment. What is the formula? C minus O, closing stock minus opening stock, minus index number average into C divided by IC, closing stock by index number of closing stock, opening stock divided by index number of opening stock. That's all. The 2 adjustment I have discussed, depreciation adjustment and COSA. Now monetary working capital adjustment. See here, when the business is performed, there is change in working capital from opening as well as closing. So we have to find out opening working capital and closing working capital. Working capital means current assets minus current liabilities. The current assets consist of trade debtors, trade bills receivable and prepayments. So these are the assets, current assets. Current liabilities are trade creditors, trade payables, outstanding expenses. So take the total of current assets minus current liability, will get working capital. So we have 2 working capital, opening, beginning of the year working capital, closing working capital. Now we have to find out the impact of this change. Impact of this change in working capital from opening to closing, because the prices have changed. The price level has changed from the beginning to the end. So the calculation of MWCA is exactly same as that of COSA. That means the monetary working capital adjustment is exactly same as the calculation of COSA, cost of sales adjustment, except that we calculate change in monetary working capital instead of stock value. So there we have stock value, here we have monetary working capital. That is the only difference. The formula is C minus O. C stands for closing working capital, closing monetary working capital. O stands for opening monetary working capital. Simply, the formula is exactly same. The only difference, here we have taken stock, here we are taking monetary working capital. Then closing monetary working capital minus opening working capital, opening monetary working capital minus IA, index number average. Closing monetary working capital divided by index of closing minus opening monetary working capital divided by index of opening. That's it. We'll get MWCA. So three adjustment I have discussed: depreciation adjustment and COSA, cost of sales adjustment, monetary working capital adjustment, MWCA. The last adjustment is gearing adjustment. Remember, gearing adjustment is there only when we have long-term debt or long-term borrowings. If we don't have long-term borrowings, then only three adjustments are there: depreciation, COSA and MWCA. So how this gearing adjustment will be calculated, will be affected, I'll explain you. The purpose of current cost adjustment, that is depreciation, COSA and MWCA, is to preserve the operating resources of the enterprise against inflation. On account of inflation, the operating expenses, resources will get affected. To protect the operating resources, we are making three adjustments. To protect the operating resources against inflation, we are making three adjustments: depreciation, COSA and MWCA. The adjustment represent the additional funds needed to make up for the impact of inflation. This additional adjustment what we are making is to protect the operating resources against the inflation. However, the assets of the business may not be entirely financed by shareholders. Normally, a company will not have only share capital. A company may have borrowed funds, long-term funds, just like debentures. That means the total assets are not financed only by share capital. Some of the assets are financed by long-term debt also. Long-term debt also. That means the entire burden of this inflation should not be borne only by shareholders, because shareholders are not the only party who is financing the assets. Apart from shareholders, the lenders or the parties from whom long-term debts has been raised, the parties must also bear the burden of this impact. However, the assets of the business may not be entirely financed by shareholders. If the business has long-term debt, the amount repayable will not change on account of changing prices, as it is fixed by agreement. So when the business borrows long-term debt, the amount of debt will remain same. It will not change on account of changes in the price level. Just like a company has borrowed 10 lakh rupees from a bank for 10 years. That means repayable after 10 years. So even after 10 years, the business has to repay 10 lakh rupees to the bank. The price level changes are not considered. Then the burden of current cost adjustment is to be shared by shareholders as well as providers of long-term debt. So whatever burden is there on account of these three adjustments, depreciation adjustment, COSA and MWCA, so whatever adjustment loss on account of these adjustment should not be borne only by shareholders. A part of this adjustment should also be borne by long-term debt providers. Then the share of long-term lenders is calculated with the help of gearing adjustment. How much is the share that should be borne by long-term debt will be calculated by calculating the gearing adjustment. Gearing adjustment is deducted from the total of the three adjustment or is added to the profit as per historical method. Two methods are there. The first method, gearing adjustment should be deducted from the three adjustments. The three adjustments are depreciation adjustment, COSA and MWCA. From these three adjustments, you can deduct the gearing adjustment, or else don't deduct these three adjustments directly. From the total, you add it to the profit. Add it to the profit gearing adjustment. Any one of the method we can follow. So how to find out gearing adjustment? Gearing adjustment is equal to L divided by L plus S into A. What is L here? Net borrowings. How much is the long-term debt borrowings? S stands for shareholders fund and A stands for total of current cost adjustment. That means total of these three adjustment. Total of depreciation adjustment plus COSA plus MWCA. That's all. So these are the four adjustments to be made in order to find out the income as per CCA method. So this is the end of the theoretical part of accounting for price level changes. In the next video, inshallah, we will start the problems on accounting for price level changes.